My name is Willem THORBECKE. I'm a senior fellow here at RIETI, and I will talk about how the coronavirus affects Japanese industries, evidence from the stock market. I want to talk about how the coronavirus has affected Japanese industries and look at evidence from the stock market. So this presentation will consist of 4 parts. So an introduction, then I will talk about the data and methodology, then the results, and finally draw a few conclusions. So what we've seen is Japan has very diligently tried to limit the spread of the coronavirus. So the schools were closed in March. There was a voluntary lockdown where non-essential businesses were requested to shut down, and only essential businesses, drugs, groceries, similar businesses remained open. There was limits on concerts, ball games, church attendance, large gatherings were restricted, travel was restricted. So Japan implemented several steps to try to limit the spread of the virus. Then by the end of May, it lifted the state of emergency and it eased some of the restrictions. And what we saw is even before the crisis, Japan had already suffered 2 major shocks. So first, the China-US trade war and slowing growth in 2019 had hit manufacturing output. So the manufacturing sector was already suffering in Japan. Then in October 2019, consumption taxes were increased from 8% to 10%. That reduced spending, caused a second blow to the Japanese economy. And so what we saw is in the 4th quarter of 2019, GDP growth was minus 7.3%. And then it was minus 3.4% in the 1st quarter of 2020. So we had 2 quarters of consecutive negative GDP growth even before the impact of the crisis. But there was one bright spot before the crisis, and there was a boom in construction going on in Japan, a boom in tourism and real estate development. There was preparations for the Tokyo Olympics, interest rates were low. So this was sort of a bright spot in the economy before the coronavirus crisis. But now the crisis has been very damaging for the Japanese economy. GDP in the 2nd quarter of 2020 is expected to fall by 20%. And so this paper tries to go beyond that headline number to look at how individual parts of the Japanese economy were affected. So which parts were affected the most, which have actually benefited. So I'm going to try to go beyond the headline numbers to look a little bit more deeply into how the Japanese economy has been affected. And so to do that, I'm going to look at how stock prices in Japan have responded. And so one benefits of stock prices is the data are available in a very timely manner, like almost immediately. The data span many, many different sectors and firms. And so it allows us to compare different firms in different sectors. So stock prices sometimes gives an early indicator to how the rest of the economy will function. So for instance, Fisher Black observed that the sector-by-sector behavior of stocks is useful for predicting sector-by-sector changes in output, profits, and investments. When stock in a given sector goes up, more often than not, that sector will show a rise in sales, earnings, and outlays for plant and equipment. And Shewart, looking at monthly, quarterly, and annual data over a 100-year time period, found that stock returns explain a lot of future industrial production growth. So there's evidence then and a long tradition of looking at stock prices to provide some evidence about how the economy is affected. So there's been previous work on this coronavirus crisis, looking at stock prices, financial markets for countries other than Japan. So for instance, Ramelli and Wagner looked at US returns, and they found initially US stocks that were exposed to China fell when the crisis was centered on China. Then as the crisis moved to Europe and the United States, they found that US firms with more debt and less cash performed worse than other US stocks. Pagano et al. Looked at the degrees to which jobs don't need close interactions to measure how firms are exposed to the crisis. So if you think of, say, dentists or haircuts, those require very close interaction. If you think of Wall Street analysts, those don't require that. So they had a measure of how much close interaction is required to perform jobs. They used that to try to examine which sectors, which firms would be exposed to the crisis. And so what they found then is firms that were exposed to the crisis, their performance was 10% worse over the 24 February to 20 March period than firms which were not exposed. So they argued that exposure to pandemic is a very serious risk factor for US stocks. Chen and March also looked at how the Dow Jones Industrial Average performed during this crisis compared to previous pandemics. They found the effect was much worse during this crisis, and a lot of that, they argued, was due to all the uncertainty surrounding this crisis. Gormson and Koijin looked at dividends futures for US stocks, and they forecasted a large drop in US dividends and US GDP growth, and the same for Europe. So what I want to do is look at Japanese stock prices and see if we can get some kind of early indication for how different sectors are being affected. So if we look, figure 1 here presents Japanese aggregate stock prices. And so what we see is that starting on the 24th of February, stock prices fell. They fell very, very rapidly until the middle of March. And since then, they've recovered to some extent. So we saw a very large shock which hit the economy starting in the 24th of February. So what I do then in this paper is I look at 76 different sectors from starting in the 24th of February until the end of May, and I try to look at how returns on those 76 sectors have performed over this period. And then I also try to divide the performance of these individual sectors, so say automobiles, auto parts, healthcare, into that which can be attributed to the macroeconomic environment and that which can be attributed to other factors. So to look at the macroeconomic environment, I use some fairly standard indicators. So I look at the return on the overall Japanese stock market, which controls to some extent for how the Japanese economy is faring. I also look at the return on the world stock market, which controls for how the rest of the world is faring. I use the yen-dollar exchange rate to control for exchange rate exposure. We know that the exchange rate can have very important effects on Japanese firms. And then I look at also the daily percentage change in the dollar spot price of Dubai crude oil to control for exposure to oil prices. So historically, Japan as an oil importer has been very exposed to oil prices. I use data from September 1st, 1993 to the end of May 2020. These data come from DataStream. Augmented Dickey-Fuller tests indicated in almost every case permitted the rejection. In all but one case, I could reject the null hypothesis that the series have unit roots. So I regressed then sectoral returns on those 76 sectors on these 4 macroeconomic factors. So then the equation to be estimated, the left-hand side variable is the return on the individual sector. So the return on healthcare stocks or machinery stocks, whatever the individual sector is. I try to explain that based on the return on the overall Japanese stock market, the return on the overall world stock market, the change in the yen-dollar rate, and the change in the log of the price of Dubai crude oil. And so then estimating equation 1, I can use that to decompose returns into the portion due to the macroeconomic environment and the portion due to sector-specific factors. So then we can see whether if an individual sector is performing poorly, so say if automobiles are performing poorly, is that because of the macroeconomic environment? Is that because there's a slowdown in Japan? Or is that because of sector-specific effects? So say, for instance, if auto dealers have to shut down in Japan, we would expect the auto industry to take a hit. So I'm trying to look at to what extent are macroeconomic factors driving performance, and to what extent are just idiosyncratic sector-specific factors. So say, for instance, travel restrictions on the travel industry, to what effect are those driving results? So then looking at the results, so table 1 in the paper presents the results. The adjusted R-squared averages 0.43, which is good for daily stock return data. So there's usually so much noise in stock return data. And so in the table, columns 2 through 4, in those columns, a value less than 1 implies that if you invested 1 yen on February 24th, it would have lost value by May 29th. A value greater than 1 implies it would have gained value. And so column 2 looks at the overall sectoral performance. Column 3 looks at what portion of that is driven by macroeconomic factors, and column 4 looks at what portion of that is driven by idiosyncratic factors. And so just to understand the numbers that I'm going to present, if we looked at the first sector listed in the table, the value of 1.3436 in column 2 indicates that if an investor had invested 1 yen in that sector on the 24th of February, it would have appreciated to 1.3436 yen. So it would have been like a 34% appreciation. The value of 0.9835 in column 3 indicates that just the macroeconomic environment would have caused that 1 yen to fall to 0.9835. The value of 1.3718 indicates that sector-specific factors, so say demand for healthcare services, would have caused that 1 yen to increase to 1.3718 yen. So I'm looking at the total performance of the sector, then what portion of that is driven by macroeconomic factors, and what portion of that is driven by sector-specific factors. So what we see then is the real estate, the travel and leisure, and the oil sectors have all performed very badly. So if we look at real estate investment trusts, in column 2, the value equals 0.7021. For mortgage finance, it equals 0.7398. For real estate, it equals 0.7578. And for home construction, it equals 0.8412. So if you had invested in real estate before the crisis, or as the crisis was hitting, those investments would have performed very, very poorly. And this has not been because of the macroeconomic environment, but because of other factors. So with this emergency, it's been much harder to perform real estate transactions. Travel and leisure has also done very badly. So if we look at the values for casino and gambling, it's 0.6951. The value for airlines is 0.7192. The value for hotels and motels is 0.8346. And for travel and tourism is 0.8977. And so again, these losses in this case, columns 3 and 4 indicate they're not driven by macroeconomic factors, but instead by sector-specific factors. So the restrictions on travel, the postponing of the Olympics, there's been very, very specific factors which have been very bad for travel and leisure. Oil has also performed badly, and this has largely been driven, again, not by macro factors, but by the lockdowns, the travel bans, other factors which have affected the demand for oil. The automobile sector has suffered, and so 1 yen invested in automobiles would be worth 8.8335, so would have lost about 17%. For auto parts, it would be 0.8652. For iron and steel, it would be 0.7333, and for tires, 0.8738. And so for automobiles, both the macroeconomic environment and the other factors have contributed equally to the losses. So we've seen exports have collapsed, which has been very bad for the auto sector. But at the same time, many dealers in Japan have been shut. So the specific factors related to the coronavirus have also hit this sector very hard. We see that electric office equipment has performed badly. The value was 0.8152. And since many offices were closed, demand for office equipment has fallen. The machinery sector has also suffered. If we look at specialized machinery stocks, which are a major product that Japan specializes in, they've decreased to 0.853. Tool stocks have decreased to 0.8842, and agricultural machinery to 0.8869. And so the losses in machinery are driven by the macro factors rather than by sector-specific factors. So there's been slowdowns in Japan, slowdowns in the rest of the world. This has reduced demand for machinery, and this has hit that sector very hard. Banks have also underperformed. And so banks had extended a lot of real estate loans, which are now at risk as the real estate sector has performed so badly. Also, many businesses have been going bankrupt, which is going to cause non-performing loans to increase. There's been sectors that have also benefited from the crisis. And in every case, they've benefited not because of macroeconomic factors, but because of sector-specific factors. So sectors related to health have done very well. So pharmaceuticals are up 1.845, biotechnology is 1.10, drug retailers is 1.2076, healthcare providers is 1.321, and healthcare services is 1.3436. So sectors related to health have done very well in the midst of this health crisis. Also, businesses that provide entertainment and distractions at home have gained. So if we look at telecommunications equipment, including smartphones, it's gone up to 1.236. Recreational services is 1.1097. Recreational products is 1.082. Electronic entertainment is 1.0681. So as people were huddled in their homes, the demand for entertainment products has increased. Delivery services have also done very well. So their value is 1.3146. So people forced to stay at home are relying more on delivery services. So this has been very good for those services. So next I tried to look at why, how we can explain just the effect of macroeconomic variables on sector returns. So obviously there's some very specific factors related to the crisis where stores are closed, people are huddled at home, but also we see that the macroeconomic environment has been affecting performance. And so I try to look a little bit about why that is in table 2. And one thing we see there is there's a very clear relationship between sectors where the macroeconomic performance matters and those sectors' exposure to the Japanese stock market. So the performance of the Japanese stock market is explaining a lot of why the macroeconomic factors are affecting Japanese stocks. Also, the world stock market matters to some extent, but really not as much. So if we look at the stock market coefficients for the Japanese stock market across the 76 individual sectors, the average coefficient was 0.87. If we look at the exposures to the world stock market, the average coefficient is 0.009. So that suggests that the Japanese stock market, and by extension, the Japanese economy, is very important for explaining the performance of these 76 sectors. The yen-dollar exchange rate had some explanatory power, but really wasn't as much. And what seemed to happen is commodities, say such as aluminum or non-ferrous metals, were harmed when the yen-dollar rate depreciates, whereas manufacturing goods benefit. So the yen-dollar rate has some explanatory power. The oil price had much less explanatory power across all of the commodities. And let me just show some figures to kind of support this. So figure 3 here looks at the relationship on the horizontal axis. We have the sector's regression coefficient to Japanese stock returns. So if, let's say if it equals 1.2, that says the sector is very sensitive to Japanese, the overall Japanese stock market. If it equals 0.4, that says the sector is not very responsive to the overall Japanese stock market. And so what we see is that seems to be a very close relationship between the sector's exposure to the Japanese stock market and their performance due to macroeconomic factors. So those which are very exposed to the Japanese stock market have done very, very badly. Those which are not exposed have done much, much better. So what that seems to imply, if we take the Japanese stock market as somehow containing information about the Japanese economy, those sectors which are very exposed to the Japanese economy have done very badly. Those which are not exposed to the Japanese economy have done much better. We can also look at the overall world economy. Again, we see a relationship where those which are more exposed to the world economy have done worse, those which are less exposed have done better. But here the relationship is not as tight, it's much more spread out. So let me just draw a few conclusions. So I've investigated how Japanese sectoral stock returns have performed during the pandemic and whether the responses were driven by macroeconomic or sector-specific factors. What we found was the Japanese machinery sector was harmed by the macroeconomic environment, not by sector-specific factors. So there's been a real slowdown in the demand for capital goods, for machinery, and that's hit the sector very hard. Real estate and travel and leisure have been harmed by specific factors, such as the effect of the lockdown and travel restrictions in this industry. So these were not affected very much by macroeconomic factors, but much more by idiosyncratic factors affecting those sectors. Electronic office equipment and automobiles have been hit both by the macroeconomic environment and by idiosyncratic factors. And then on the other hand, sectors related to health and the ability to obtain entertainment and goods and services at home have done well. And they've gained entirely because of sectoral characteristics and not at all because of macroeconomic changes. So I also investigated why sectors were harmed by macroeconomic factors. And there's a very strong relationship between sectors that have underperformed and their exposure to the overall Japanese stock market. So then the sooner that the Japanese government, the Japanese people can bring the coronavirus under control, the better for sectors such as real estate and tourism that have suffered from these restrictions on personal contacts. So clearly, the sooner that the crisis can be brought under control, things can return to some semblance of normality, the better for the Japanese economy. And also, a recovery in the Japanese economy would be very good for sectors that have been harmed. So sectors such as automobiles or machinery that have been harmed. So the Japanese economy seems to have the most explanatory power of any of the macroeconomic variables. So this suggests that nurturing the Japanese economy, bringing it back to recovery, would be very important for helping firms to recover from this devastating crisis. Thank you very much.